video, we're going to talk about the closing entry. So this is done at the end of a company's fiscal year. It's only done one time a year. And basically, it's a way of resetting the company's temporary account. So when you're thinking about temporary accounts, I always say, think about the word red. Revenues, expenses, and dividends. Those are your three types of temporary accounts. And a temporary account means that we're only going to have those accounts track information for a 1-year time frame. So every year we kind of want to hit the reset button, set those balances back down to zero, and then kind of start over again and fresh for the new year. So just simply thinking about something with your revenues and expenses. We know our revenues minus our expenses gets us our net income. So if I told you this year the company had a net income of $10 million, you'd probably say, well, they did really well. But if I told you last year that they did a net income of $20 million, well, now we see that they're not doing as well. Or maybe last year they only did a net income of $5 million and now they're doing really well. So companies need that comparison from year to year. So we can't just have those numbers keep accumulating as the business goes. So we have to reset those values, kind of bring them down to zero. But we know that, again, revenues minus expenses gets us our net income or our net loss. That impacts our retained earnings. We also know our dividends also impact our retained earnings. So we're going to basically transfer those values into our retained earnings account, just the same way that we do on our statement of stockholders' equity. So we're basically trying to update our retained earnings account to show what it really is, like we see on our statement of stockholders' equity as its ending balance. So when we're talking about doing a closing entry just simply means we're going to do the exact opposite of whatever balance the account has prior to us actually doing that closing entry. So we know all of our dividends and expenses, their normal balance is a debit. So to make them zero, we're going to credit them. We know our revenues accounts normally have a credit balance. So if we want to make them zero, we're going to debit them. So the first thing that I suggest doing prior to actually starting your closing entries is to determine whether we have a net income or net loss, because we know that we have to journalize our entries with any debited account listed first, followed by any credited account. So if we ended up having a net loss, that means our retained earnings would have to be reduced, and we would have to debit retained earnings. Versus if we had a net income, we'd want to increase retained earnings, and we know since retained earnings is an equity account, to increase it, we would credit it. So looking at this, if we do our calculations, we have our fees earned of $808,500. We subtract away all of our expenses that are listed. That would leave us a net income of $302,650. So now that we know that it's a net income, we know that we can put together our closing entries. So all of our closing entries are dated as the last day of our fiscal year, which they told us here was June 30th. And we're going to start closing our revenues and our expenses. So we're going to close those two together. So revenues, we had fees earned. Revenues normally have a credit balance because they increase with a credit. So to make it zero, we're going to do the exact opposite, and we're going to debit it. All of our expenses have normal debit balances. That's how they increase. So to decrease them, we're going to do the exact opposite, and we are going to credit it. And your expenses don't have to go in any particular order for your journal entry. I know our financial statements, I talked about how they have to go in order of greatest to least, with miscellaneous coming last. You don't have to do that in terms of a journal entry, but they just happen to be in that order for us here. So when we're thinking about our journal entries, we've been talking about this since chapter 2. We said we have some really important rules that we have to follow. So the first rule was any account that's being debited has to be listed first, which we have done, followed by any account that's being credited, and then our debits and credits always have to equal. So we can see right here that our debits and credits do not equal. So we know the difference between our revenues and our expenses is net income. Net income gets carried down to our statement of stockholders' equity, and it gets added to our retained earnings. So my retained earnings account is not being closed. So we see over here retained earnings is at a little over $1.3 million. I'm not doing anything with that number currently. I am not closing that account out. What I'm trying to do is I need to update that balance with the amount of net income that happened during that period of time. So one of the very important things that you should do when you do this first closing entry is to double check that your debits and your credits equal. Because if by accident you put in that $1.3 million value here, your debits and credits are not going to equal. So again, key thing to do first and foremost before doing your closing entries, determine if you have a net income or a net loss. Write that number down, circle it somewhere, and make sure that that net income or that net loss number appears in your closing entries, because that's what we're transferring to our our retained earnings. The next one we have is we have to close our dividends. Again, think about the word red. We just closed our revenues and our expenses. Now we have to close our dividends. So dividends, if again, we think about our statement of stockholders' equity, we know dividends reduce retained earnings. So I have to show that happening here as well. So retained earnings is an equity account to us. It increases with a credit, which means it decreases with a debit rather. And our dividends normally have a debit balance. So if I want to close that, we need to credit. So we have effectively closed our revenues, our expenses, and our dividends, and we have transferred the impact of those accounts, that being your net income and your dividends, to the retained earnings account. Again, exactly like what we see on our statement of stockholders' equity.